Friends, thank you for being here today. What if I told you that a 179-year-old financial institution just looked at the mathematics of survival and decided it was impossible? What if I told you that on December 2nd, 2025, one of Canada's oldest banks effectively raised a white flag and said, "We cannot do this anymore"? Not restructuring, not pivoting, surrendering. Laurentian Bank, founded in 1846, before Canada was even a country, just announced it is exiting retail banking entirely, selling its branches to National Bank, offloading its commercial lending arm to Fairstone, a shadow banking entity backed by private equity. This is not a merger. This is not a strategic partnership. This is a liquidation event. This is an institution being sold for parts because the cost of staying alive has become mathematically prohibitive. And here is what should terrify you. The market celebrated. The stock price jumped on the announcement. Investors cheered because they finally get to extract cash from a dying organism before the body goes cold. That is not a vote of confidence. That is a liquidation premium. It is the financial equivalent of vultures circling, grateful they can pick the bones clean before someone else does. Now, we are told constantly that the Canadian banking system is an unshakable fortress. The big six banks, Royal, TD, Scotia, BMO, CIBC, National, are supposed to be the envy of the world, regulated, diversified, stress-tested. We are told they learned the lessons of 2008. We are told they are too disciplined, too boring, too Canadian to fail. And yet, the fortress just lost a tower. Let me give you the scale of what we are witnessing, because the numbers are not abstract. They are forensic evidence of structural failure. In the fourth quarter of 2025, Laurentian Bank reported a provision for credit losses of $18 million. That is the money they had to set aside to cover loans that are going bad. That number is up nearly 80% from the previous year when it was 10.4 million. This is not a bump, this is a spike. This is the leading indicator that their borrowers, commercial businesses, real estate developers, leveraged entities, are beginning to default in real time. But it gets worse. Wall Street analysts expected Laurentian to deliver earnings per share of 78 cents. They delivered 73 cents, a 6.8% miss. And it is not because of some unforeseen black swan event. It is because the interest rate environment of 2024 and 2025 has turned their business model into a death trap. The CEO stood on the earnings call on December 5th and explicitly stated that the retail banking landscape in Canada has become too competitive and that regulatory requirements are rising to a level that smaller institutions simply cannot afford to meet. Let me translate that corporate speak for you. The cost of doing business in Canada has become so prohibitive that only the giants can survive. The middle class of banking is being systematically wiped out, and Laurentian is not an outlier. It is the canary in the coal mine. Here is the mathematical reality that Laurentian could not escape, and this is a structural fault line that extends far beyond one regional bank. When you run a bank, your business model is deceptively simple. You borrow money from depositors at one interest rate, and you lend it out to borrowers at a higher rate. The difference between what you pay and what you earn is called your net interest margin. That margin is your oxygen. It is how you cover your operating costs, pay your employees, satisfy regulators, and generate profit. Laurentian's net interest margin collapsed to 1.79%. Think about that. For every dollar they lend out, they are making less than 2 cents in profit before expenses. You cannot run a bank on razor-thin margins when your loan book is starting to rot. You cannot survive when defaults are rising and your margin for error has been compressed to nothing. And here is where the model breaks. When interest rates were near zero for over a decade, banks like Laurentian could get away with thin margins because defaults were low and credit was easy. Money was abundant. Liquidity was infinite. Everyone could refinance. Everyone could roll over debt. But when central banks jacked rates from 0.25% to 5% in under 2 years, the scaffolding collapsed. The borrowers who were fine at 2% interest are drowning at 6%. The commercial real estate projects that penciled out in 2021 are hemorrhaging cash in 2025. And the small banks that do not have the deposit base or the diversification of the giants are the first to crack. Let me give you a metaphor to simplify this mechanism, because this is the black box that most people never see. Imagine you run a pizza shop. You borrow dough, flour, yeast, water from a supplier at a certain cost. You turn that dough into pizzas and sell them at a markup. Your profit is the difference between the cost of the dough and the price of the pizza. Simple. Now imagine the cost of dough suddenly triples. Flour prices skyrocket, yeast becomes scarce, your supplier jacks up rates because they are facing their own cost pressures. At the same time, your customers stop buying as many pizzas because they are broke. Inflation has eaten their paychecks. Discretionary spending has evaporated. Your revenue falls, your costs explode, and your margin disintegrates. That is exactly what happened to Laurentian Bank. The dough is deposits. The pizzas are loans. The cost of attracting deposits went through the roof because the Bank of Canada raised rates, and depositors now demand higher yields, or they walk. At the same time, demand for new loans, mortgages, commercial credit, business expansion has cratered because borrowing at 6% or 7% is prohibitively expensive for most businesses. Laurentian got squeezed from both sides. Their net interest margin imploded and their loan book started to spoil. But there is a deeper secret here, a dynamic that most people never connect. When a bank's margins get crushed and defaults start rising, they face a brutal choice. Either raise capital by issuing new shares and diluting existing investors, or shrink the balance sheet by selling assets and exiting business lines. Laurentian chose the latter. They looked at the math of 2026 and realized if interest rates stay elevated, if commercial borrowers keep defaulting, if regulatory capital requirements keep rising, we will be insolvent within 18 months. So they pulled the ripcord. And here is the part that should make your blood run cold. Laurentian is not unique. They are just the first domino visible to the public. Behind the scenes, dozens of smaller lenders, credit unions, regional banks, and shadow banking entities are staring at the same math. They are all running the same stress tests. They are all coming to the same conclusion. The question is not if more institutions will fail. The question is when and how fast the contagion spreads. Now, let me take you back to the origin of this crisis, because to understand why Laurentian collapsed, you need to understand the genesis myth of the modern banking system. This is not a story that started in 2024. This is the final act of a tragedy that has been building for decades. In the aftermath of the 2008 financial crisis, central banks around the world made a choice. They decided that the traditional business cycle, boom, bust, recession, recovery, was too painful, too disruptive, too politically unacceptable. So they engineered a permanent boom. They dropped interest rates to zero. They printed trillions in new currency through quantitative easing. They flooded the system with liquidity and told the world, we will never let asset prices fall again. For over a decade, that worked. Stock markets soared. Real estate prices doubled, then tripled. Corporate debt exploded because borrowing was essentially free. Governments borrowed trillions because bond yields were negligible. The entire global economy became addicted to cheap money. And banks, especially smaller regional banks like Laurentian, built their business models around that assumption. They assumed rates would stay low forever. They assumed liquidity would always be abundant. They assumed the central bank put, the implicit guarantee that policymakers would always step in to prevent a crash, was ironclad. And then in 2022, inflation arrived. Not the tame 2% inflation that central banks target, real inflation, the kind that shows up in grocery bills and rent payments and electricity costs, the kind that voters riot over. And central banks panicked. They realized they had lost control of the narrative. So they did the only thing they could. They jacked interest rates at the fastest pace in modern history. The Bank of Canada went from 0.25% to 5% in under 24 months. The Federal Reserve followed the same playbook, and every bank, every borrower, every leveraged entity that had built their model on the assumption of cheap money suddenly found themselves in a world where the rules had changed overnight. This is what I call the interest rate shock, and Laurentian Bank is patient zero. They spent years trying to modernize, trying to digitize, trying to compete with the big six by offering sleeker apps and better customer service. But none of that mattered when the cost of funding their loan book tripled and their borrowers started to default. They were swimming naked, and when the tide of liquidity went out, everyone could see. Now, here is the secret that ties all of this together. The mechanism that most people never understand. When a bank fails, it is never just that bank. Banking is a system built on confidence and interconnection. Laurentian's retail customers are being transferred to National Bank. Their commercial loans are being sold to Fairstone, a shadow banking entity that operates outside the traditional regulatory framework. This does not eliminate the risk. It simply moves it. It transfers it from a regulated, visible institution to an opaque, less supervised corner of the financial system. And this is where the contagion begins. Because if Laurentian's commercial borrowers are defaulting now, what makes you think the commercial borrowers at CIBC or Scotiabank are doing any better? They are all operating in the same economy. They are all facing the same interest rate environment. They are all exposed to the same asset class, Canadian commercial real estate, which is quietly imploding as office vacancies rise and property values crater. This leads us to the system's most crucial secret, which we will explore in the next phase. The big six banks are not immune. They are simply better at hiding the rot. And when the rot becomes visible, the fortress will not just lose a tower. The entire structure will be at risk. Now let me show you exactly how the contagion is already spreading, because this is not theoretical. This is happening in real time, and the evidence is forensic. On December 5th, 2025, Laurentian Bank held its quarterly earnings call. The numbers were catastrophic, but more importantly, the language was revealing. Revenue down 3% year over year, net income down 23%, but buried in the footnotes was the real story. The provision for credit losses spiked because of one specific category, commercial loans, not consumer credit cards, not residential mortgages, commercial loans. These are the loans made to businesses, to real estate developers, to leveraged entities that borrowed heavily when money was cheap and are now suffocating under the weight of high interest rates. Let me be very specific about what this means. A commercial loan default is not like a consumer missing a credit card payment. When a commercial borrower defaults, it is because their entire business model has failed. It means a construction project has stalled. It means a retail chain is closing locations. It means a real estate developer cannot lease their properties and cannot service the debt. And when those defaults start to cluster, When they start to show up across multiple banks in the same quarter, that is not bad luck. That is a systemic failure. And here is the first canary. Laurentian is not the only institution seeing this. They are just the only one small enough and desperate enough to admit it publicly. The big six banks have not reported their first quarter 2026 earnings yet, but if you know where to look, the cracks are already visible. Let me give you a specific metric that Wall Street watches, but the public ignores: the efficiency ratio. This is the percentage of revenue that a bank spends just to keep the lights on. Salaries, technology, branches, compliance, regulatory costs. A healthy bank aims for an efficiency ratio around 55%. That means for every dollar of revenue, they spend 55 cents on operations and keep 45 cents as gross profit before provisions and taxes. Laurentian Bank's efficiency ratio in Q4 2025 hit 77.2%. Let me repeat that. They're spending 77 cents to make $1. That is unsustainable. That is a death spiral. And it is not because they are poorly managed. It is because the regulatory burden in Canada has become so onerous and the competitive pressure from the big six so intense that smaller institutions simply cannot achieve the scale necessary to survive. Now, here is where it gets truly dangerous. The big six banks have efficiency ratios in the mid-50s. They are more efficient because they have scale. They have tens of thousands of employees, billions in assets, diversified revenue streams. They can spread their regulatory costs across a much larger base. But efficiency does not protect you from a rotten loan book. And if commercial defaults are spiking at Laurentian, they are spiking everywhere. The big six are just better at hiding it for now. Let me give you the second canary, and this one is even more insidious. Laurentian sold its commercial lending arm to Fairstone Financial. On the surface, this looks like a clean exit. Fairstone takes over the loans. Laurentian gets cash. Everyone moves on. But here is what that transaction actually represents. It is a transfer of risk from the regulated banking system to the shadow banking system. Fairstone is not a bank. It is a private equity-backed alternative lender. It operates outside the traditional regulatory framework that governs institutions like Laurentian or the Big Six. It does not have to meet the same capital requirements. It does not have to report to the Office of the Superintendent of Financial Institutions in the same way. It exists in the shadows, which is exactly where risk goes to hide when the regulated system can no longer contain it. And this is a pattern we have seen before. In 2008, when the subprime mortgage crisis erupted in the United States, the rot did not start in the big banks. It started in the shadow banking system. Subprime lenders, mortgage originators, structured investment vehicles. These entities operated outside traditional oversight, packaged garbage loans into securities, sold them to pension funds and institutional investors, and when the defaults hit, the contagion spread back into the regulated system and nearly collapsed the entire financial architecture. We are watching the same movie play out in Canada, just with a different cast. Laurentian's commercial loans are now Fairstone's problem, but Fairstone is funded by institutional investors, pension funds, insurance companies, endowments. When those loans start to default, and they will, the losses will flow back into the broader financial system. The risk has not been eliminated. It has been obscured. It has been moved into a corner where the public cannot see it until it explodes. Now let me show you the third canary. And this is the one that connects Laurentian's collapse to the broader crisis in Canadian banking. The mechanism is called counterparty risk, and it is the silent killer of financial systems. Here is how it works. Banks do not operate in isolation. They lend to each other constantly in the overnight funding markets. They use each other as counterparties for derivatives trades. They hold each other's bonds as assets on their balance sheets. The entire system is a web of interconnected obligations, and it only functions if everyone believes everyone else is solvent. When Laurentian announced it was exiting retail banking and selling its commercial arm, it sent a signal to the interbank market: we are not healthy. We cannot survive the current environment. And once that signal is sent, other banks become cautious. They start to ask, if Laurentian is failing, who else is failing? If their commercial borrowers are defaulting, are our commercial borrowers next? And as that doubt spreads, liquidity starts to freeze. Banks stop lending to each other as freely. They hoard cash. They raise the price of overnight funding. And that liquidity squeeze makes the underlying crisis worse. This is the mechanism that turned the subprime mortgage crisis of 2007 into the global financial crisis of 2008. It was not just that some borrowers in Nevada and Florida defaulted on their mortgages. It was that once Bear Stearns and Lehman Brothers collapsed, every bank in the world started to question whether their counterparties were solvent. Credit markets froze, liquidity evaporated, and the entire system came within hours of a complete breakdown. Now, I am not saying we are at that point yet, but the ingredients are the same. A small institution fails, confidence erodes, counterparty risk spikes, liquidity tightens, and the crisis spreads. Let me give you the brutal reality of where we are right now, because this is the no escape encirclement that should keep you awake at night. If you are a retail customer of Laurentian Bank, you are now a customer of National Bank, whether you chose that or not. Your deposits have been transferred. Your mortgage, if you have one with Laurentian, is now serviced by National. You have lost a choice in the marketplace. And here is the deeper problem. Canada just lost another competitor in the banking sector. 5 years ago, HSBC exited the Canadian market and sold its operations to Royal Bank. Now, Laurentian is being dismantled and absorbed by National. The oligopoly is tightening. There are fewer players, less competition, and when competition decreases, prices go up, fees go up, the cost of borrowing goes up, the interest you earn on deposits goes down. For the big six banks, this is great news in the short term. They just absorbed a competitor's customer base without having to compete for it. National Bank gets Laurentian's retail deposits at a discount, but in the long term, this consolidation is a warning sign. It means the Canadian banking system is becoming more concentrated, more fragile, more dependent on the survival of a handful of institutions that are themselves increasingly exposed to the same structural risks that killed Laurentian. And here is the trap. You, as a consumer, have nowhere left to hide. You are either banking with one of the big six, or you are banking with a shadow lender like Fairstone, or an online-only platform that has no physical branches and operates with even thinner margins. The middle ground is gone. The regional banks that once provided an alternative are being systematically eliminated. Now, let me connect this to the broader crisis that is unfolding across the developed world, because Laurentian's collapse is not happening in a vacuum. It is part of a global pattern of stress in the financial system, and the convergence of forces is accelerating. The first force is interest rates. For over a decade, central banks suppressed interest rates to near zero. That created an entire generation of businesses, borrowers, and financial institutions that have never operated in a normal rate environment. When rates spiked from 0% to 5% in under 2 years, it was like turning on the lights in a room full of cockroaches. Suddenly, every over-leveraged borrower, every zombie company, every marginal bank was exposed. Laurentian could not survive in a 5% interest rate world because their business model was built for a 0% world, and they are not alone. Across Europe, regional banks are quietly failing. In the United States, we saw Silicon Valley Bank, Signature Bank, and First Republic collapse in a matter of weeks in 2023. Those failures were blamed on mismanagement, on concentrated depositor bases, on poor risk controls. But the real cause was the same: an interest rate shock that destroyed the value of their bond portfolios and triggered a liquidity crisis. The second force is regulatory burden. After 2008, governments around the world imposed stricter capital requirements, stress testing, compliance mandates. The intention was noble: make banks safer, prevent another crisis. But the unintended consequence was that only the largest institutions can afford to comply. Smaller banks, regional players, community lenders, they are being crushed under the weight of regulatory costs. Laurentian's CEO admitted this explicitly. The cost of compliance has become prohibitive for anyone who does not have the scale of a big six bank. And the third force, the one that nobody wants to talk about, is commercial real estate. This is the silent rot at the heart of the banking system, and it is metastasizing. During the pandemic, office occupancy collapsed. Entire downtown cores emptied out as employees worked from home. Companies realized they did not need as much office space. Leases expired and were not renewed. Property values started to fall, and the developers and landlords who borrowed heavily to build and buy those properties are now underwater. Here is the math. If you borrowed $80 million to build an office tower in 2019, and that tower was worth $100 million, you had $20 million in equity. But if that same tower is now worth $60 million because nobody wants to lease office space, you are $20 million underwater. You owe more than the asset is worth. And if you cannot service the debt, you default. The bank forecloses, sells the property at a loss, and takes the hit. Laurentian's provision for credit losses spiked because their commercial borrowers, many of whom are exposed to real estate, are starting to default. And this is not unique to Laurentian. Every bank in Canada, every bank in the United States, every bank in Europe that has commercial real estate exposure is staring at the same problem. The question is not if those losses will materialize. The question is how big they are and how fast they hit. Now, here is where the convergence becomes truly terrifying. We are facing a convergence, three distinct forces hitting at once, and the banking system is caught in the crossfire. Force number one: high interest rates crushing profit margins. Force number two: regulatory burden killing smaller institutions and concentrating risk in the giants. Force number three: commercial real estate weakness spiking loan defaults across the entire sector. And here is what makes this convergence so dangerous. These three forces are not independent variables. They are interconnected. They amplify each other. High interest rates make commercial real estate loans unaffordable to refinance, which triggers defaults, which spikes provisions for credit losses, which crushes bank profitability, which forces smaller banks like Laurentian to exit the market, which concentrates risk in the big six, which makes the entire system more fragile. This is not a problem that can be solved by better management or smarter regulation. This is a structural fault line. This is a mathematical endgame, and Laurentian Bank is the proof of concept. Now, let me take you inside the psychology of what happens next, because the real danger is not in the balance sheets. It is in the human mind. There is a cognitive bias that every investor, every depositor, every homeowner needs to understand right now. It is called normalcy bias, and it is the reason most people will be caught completely off guard when the crisis accelerates. Normalcy bias is the brain's tendency to believe that tomorrow will look like yesterday. It is the assumption that because your bank has always been there, it will always be there. Because your deposits have always been safe, they will always be safe. Because the housing market has always recovered, it will always recover. This bias is hardwired into human psychology. It is a survival mechanism that helps us function day to day without being paralyzed by existential fear. But it is also the mechanism that gets people killed in disasters. It is the reason people stay in their homes during hurricanes, even when evacuation orders are issued. It is the reason passengers on sinking ships wait too long to get into lifeboats. It is the reason depositors at Silicon Valley Bank waited until the final hours to pull their money, even though the warning signs were visible for months. And it is the reason most Canadians are not paying attention to Laurentian's collapse. Because in their minds, Laurentian is a small regional player. It is not Royal Bank. It is not TD. It is not one of the giants. So the brain says, this is an outlier. This is a special case. This does not apply to me. But here is the truth. Laurentian is not an outlier. It is the leading indicator. It is the first crack in the dam, and the flood is coming. Let me give you another psychological concept that is even more insidious: the money illusion. This is the phenomenon where you feel wealthier because the numbers in your account are bigger, even though your purchasing power has declined. You become a millionaire on paper, but poorer at the grocery store. Here is how this applies to the banking crisis. When Laurentian's stock price jumped on the announcement of the sale, investors felt like they won. They got liquidity, they got an exit, but what they actually got was the mathematical confirmation that the long-term business model is dead. They traded a potentially viable institution for a one-time cash payout. They chose the certainty of a small gain today over the uncertainty of larger losses tomorrow. And this is the same psychology that will drive the next phase of the crisis. When depositors at smaller banks, at credit unions, at regional lenders start to feel uncertain, they will not ask questions. They will not wait for official reassurances. They will simply move their money to the big six. And that flow of deposits from weak institutions to strong institutions will accelerate the collapse of the weak and concentrate even more risk in the giants. This is how contagion works. It is not rational. It is not orderly. It is a stampede driven by fear. And once it starts, it is almost impossible to stop. Now, let me bring this back to the binary choice that every person watching this needs to make, because we are running out of time to prepare. The question you need to ask yourself is not whether the Canadian banking system will survive. It will. The big six are too systemically important to fail. The government will not allow Royal Bank or TD to collapse. They will print money, they will inject capital, they will do whatever it takes to keep the lights on. The question you need to ask is, at what cost? And who pays that cost? When Laurentian exited retail banking, their customers did not lose their deposits. Those deposits were transferred to National Bank, but the depositors lost choice. They lost competition, and in the long run, they will pay higher fees and receive lower interest because the oligopoly just got tighter. When the big six banks start to absorb the losses from commercial real estate defaults, they will not fail, but they will pass those costs on to consumers. Mortgage rates will stay elevated even when the Bank of Canada cuts rates. Lending standards will tighten, access to credit will shrink, and the economy will slow because the flow of capital will constrict. And here is the most important part. When governments step in to bail out the system, they will do it by printing money. They will expand the money supply. They will monetize debt. And that means inflation. It means your savings, your pension, your salary, everything denominated in Canadian dollars will lose purchasing power. So the binary choice is this: do you own assets or do you own claims on assets? A bank deposit is not an asset. It is a claim on an asset. It is a promise that the bank will give you your money back when you ask for it. But if the bank is insolvent, if the system is under stress, that promise is only as good as the government's willingness to print money to honor it. A share of stock is not an asset. It is a claim on a company's future earnings. But if that company is leveraged, if it is dependent on cheap credit, if its business model is built on the assumption of low interest rates, then that claim is worthless when the model breaks. An ETF is not an asset. It is a portfolio of claims on other assets bundled together and sold to you at a fee. And when liquidity drains, when redemptions spike, when the underlying assets lose value, that ETF can collapse in price faster than you can sell it. But gold, physical gold that you hold in your hand, is an asset. It is not a claim on anything. It is not dependent on any institution's solvency. It is not a promise. It is a thing. And for 5,000 years, it has been the ultimate store of value when fiat currencies fail and financial systems collapse. Silver is an asset. Land is an asset. Commodities are assets. These are the things that exist in the physical world that have intrinsic value that cannot be printed or inflated away. Now, I am not telling you to sell everything and buy gold bars tomorrow. I am telling you to think about the structure of your wealth. How much of what you own is real and how much is paper? How much is dependent on the continued functioning of a financial system that is showing visible cracks? How much is a promise that might not be kept? Because here is the reality that Laurentian Bank has just demonstrated. Institutions that have survived for 179 years can disappear in a matter of months when the mathematics of survival turn against them. The assumptions that held for decades can collapse in weeks, and the safety you thought you had can evaporate before you have time to react. This is not about fear. This is about clear-eyed recognition of structural risk. This is about understanding that we are living through a transition from a world of abundant liquidity and cheap money to a world of scarce capital and expensive credit. A transition from illusion to reality, from paper wealth to hard assets. And in that transition, the institutions that cannot adapt will fail. Laurentian Bank failed. It is not the last. Watch the provisions for credit losses in the Q1 2026 earnings reports from CIBC, from Scotiabank, from BMO. If those numbers spike, if commercial loan defaults accelerate, then this is not a regional bank problem. This is a systemic crisis. Watch the efficiency ratios. If the big six start to see their operating costs rise faster than their revenues, if their margins compress, if they start cutting staff and closing branches, those are the early warning signs that the pressure is spreading. Watch the commercial real estate market. If property values continue to fall, if office vacancies continue to rise, if major landlords and developers start to default, that is the rot spreading through the loan books of every major bank in the country. And most importantly, watch the policy response. Because when the crisis becomes undeniable, when the contagion spreads beyond the small players and starts to threaten the giants, the government will act. They will announce rescue packages. They will inject capital. They will guarantee deposits. And they will do it all by expanding the money supply, by printing currency, by debasing the Canadian dollar. That is the moment when the money illusion becomes painfully real. That is the moment when you realize that your deposits are safe in nominal terms. You will get your dollars back, but worthless in real terms because those dollars buy less and less with each passing month. This is the hidden tax of financial system rescue. The government does not explicitly confiscate your wealth. They simply dilute it. They inflate it away, and by the time you realize what has happened, it is too late to protect yourself. So the call to action is simple. Diversify out of pure paper claims and into real assets. Not because you are betting on collapse, but because you are preparing for transition, You are stepping out of the line of fire. You are acknowledging that the rules of the game have changed, and the strategies that worked in a 0% interest rate world do not work in a 5% world. Laurentian Bank tried to adapt. They spent years modernizing, digitalizing, competing. It did not matter. The structure of the system turned against them and they could not survive. The question now is whether the Big Six can survive the same pressures or whether they are simply large enough to fail more slowly and more expensively. And while that question plays out, while the crisis unfolds in slow motion, the people who prepared, the people who recognized the fault lines early, the people who shifted from paper to real assets, those are the people who will preserve their wealth through the transition. History favors the prepared, and the window for preparation is closing. Laurentian Bank is not a footnote. It is a warning shot. It is the first domino falling in a chain that stretches across the entire Canadian banking sector. And when the next domino falls, it will fall faster and harder because the market will have learned the lesson. No institution is safe when the mathematics of survival turn against them. Friends, we are living through a moment of profound structural change. The illusion of Yongju cheap money is over. The fantasy that central banks can prevent all pain and all loss is shattered. The belief that 179-year-old institutions are invincible has been proven false. What remains is reality, and reality is hard assets, scarce capital, and the brutal mathematics of survival in a high interest rate world. The choice is yours, but the clock is ticking.